This is Chokkalingam Palaniappan from Prakala Wealth Private Limited. Today I would like to explain you why I love mutual funds. It's not because that I am in this profession. Since I love mutual funds, I came into this profession. There are many reasons why I love mutual funds. The first and foremost being highest returns. The best returns among all investments that are available for retail investors. Say like when you compare with real estate, when you compare with gold, when you compare with recurring deposit, when you compare with PPF, RD, whatever, all those things, when you compare with all those investments over longer periods, equity mutual funds have done a good job and they are expected to do well. That is my belief. In the future also, they will do pretty well. The second reason being, mutual funds are the friend of small investors. Why I say friend of small investors? Because you can invest little by little and get the best returns. You can put small amounts now and then or month on month, and you can get one of the best returns. Then, as we say, small drops make a ocean. The small amounts, that rupees 500, 1000, 5000, 10,000, whatever, 50,000, 1 lakh per month that you keep on saving, it gets accumulated, and once after 10 years or after 15 years when you see, it will be in lakhs minimum, and many times it will be in crores. Then the fourth point is, even if you would love to get cheated, you can't get cheated in mutual funds. People go invest in chits, people go invest in some high return monthly assured return investments and get cheated completely. Here you can't get cheated. That leads me to the next point. When regulation becomes stricter, the industry grows. Today mutual funds manage lakhs and lakhs of crores, and the regulator is SEBI, Securities and Exchange Board of India. I would say they are one of the best regulators in the country, and their utmost aim is to take care of retail investors' interest. So you can be rest assured, a third eye is looking into your investments. Next point is, one of the cleanest investments. You pay by check, you get back by check. You pay online, you get back online. However it is, there is no black, there is no, it's completely white. There is no talk of black and white. In real estate they say 50% black, 50% white, or whatever, all those things. Here it is completely white money. Then the next point is flexibility. It's highly flexible. Whenever you want, you can start. Whenever you want, you can stop. Whenever you want to invest, you can invest. Whenever you want to take out the money, you can take out the money. Whenever you want to pause, you can pause it. Say, let us assume you are investing monthly 20,000 rupees. All of a sudden you lose your job. So for the next 3 months, you can pause the investment, or you can just stop it. Whenever you get back the job, you can reinvest. You can restart the investment in the same account, in the same folio. Similarly, if you want for emergency all the money that you have invested, you can take it out. You will get in 1 day in case of debt funds. In case of equity funds, you will get it in 3 to 4 days. So there is, of course, the risk is yours. In the shorter duration when you take out, there could be loss as well. However, the money is available for you. So the flexibility. Then the next point is tax efficiency. Now, one of the highly tax efficient investments in India today is mutual funds. Until you take out, you need not pay tax. In case of equity mutual funds, it is just, up to rupees 1 lakh of profit per year per person is tax free. Over and above that, you have to just pay 10% taxes, even though your tax bracket could be 30, 40, whatever it is. And that too when you take out. In case of debt funds, if you hold on at least 3 years, then you have to pay just 20% after adjusting for inflation. That means indexation, which will be very, very minimal when you compare with FD. On the contrary, if you invest in FD, even if you receive interest in hand or not, you have to keep paying taxes in your tax bracket. So make sure that your investment is tax efficient. If you want to take part in India's growth story, then definitely you have to invest in equity mutual funds. you can be rest assured you will be getting returns on par with India's growth or above that. Whenever someone wants to reach his goal in a shorter time frame, or to reach the goal with lesser amount, mutual funds stand out there. Let me tell you an example. If you invest 10,000 rupees per month for 30 years in equity mutual funds, and if I assume a 12% rate of return every year, your corpus or your maturity amount would be approximately 2.90 crores, 2 crore 90 lakhs. At the same time, if you invest in a recurring deposit 10,000 rupees per month for 30 years, I am not taking any tax into account at all. At the end of 30 years, your return will be approximately 1.13 crores or 1 crore 13 lakhs. So now you see the difference. So over longer period, compounding at a higher rate makes wonders. Then you need not feel that I have, in Tamil we say that, I have inserted my neck, I can't get out of it. This happens many times with endowment policies, money back policies, or whole life policies, all those things. Or in case of purchase of a land, you can get in, but getting out is difficult. That is not the case with mutual funds. Anytime you can come out freely, because most of the funds are open-ended. Make sure that you invest in open-ended funds. Some of the mutual fund schemes also give free insurance for the SIP, systematic investment plan, month-on-month investments. They cover your life free of cost. We are interested in making more lakhpatis and crorpatis, and that is doable very well in mutual funds. From my past 15 years experience in this industry, if you ask me to do another job, I will never accept, because I love this industry, this mode, this investment, and its genuineness, its regulation. So this is one of the wonderful investments, mutual funds. And if you would also like to make money, in lakhs or in crores over a period of time, gradually accumulating, taking the market risk, then this is the wonderful thing. Please get in touch with us. We would be glad to help you. One may ask, are mutual funds, don't they have any disadvantage at all? Yes, they do have. The major being volatility. There will be ups and downs. Today, if you invest 1 lakh in a equity mutual fund, and if you look back tomorrow and see, it could be 99,000. After 3 months, it could be 90,000. After 6 months, it could be 80,000. At the same time, it could be 1,50,000 or 2 lakh or 1,10,000, whatever it is. It can go up and down in short time frame. So that's what we call it as volatility or risk. It is similar to a land investment or gold investment. When you invest in gold, when you invest in land, the price goes up or goes down. But over a period of time, definitely all these investments will go up. Similarly, mutual fund will also go up over a longer duration. So that is the disadvantage. That is the only disadvantage, if I can think through. That too in equity mutual funds. Debt mutual funds are comparatively safer, because they don't take that much risk. They generally invest in bonds and good quality bonds. So of course there is a small interest rate risk and credit risk, but that are well managed. So overall, when I compare with the equity mutual funds, debt mutual funds carry lower risk but lower return as well. Anyway, those are the disadvantages, if I can name a few. But over a period of time, mutual funds are given wonderful returns. We have even put videos in the past comparing SIP returns of different category of funds. You might have seen 21%, 22%, 24% return, 19%, 18%, 14%, 12% return. So many of those funds through SIP have wonderful returns. I urge you to invest in through SIP method. Over a period of time, you can make very good money. Thank you very much. See you in another video.